Hi, I'm Domingo Rodriguez, and I'm a graduate with an MBA in Public Accounting, and I will be walking you in detail through the fundamentals of financial accounting. I will start with the very basic, what is a balance sheet? I will cover the fundamentals, which do include the financial statements, the balance sheet, the statement of net income, statement of retained earnings, and the statement of cash flow. But first, let us start with the balance sheet. A balance sheet is one of the most essential financial statements for any company. But what is a balance sheet? A balance sheet, in essence, is a snapshot as of a specific period of the financial health of a company. It is primarily used by shareholders or any other stakeholders to determine whether or not this company is in good financial standing. Now, there is a formula that will never change in financial accounting, and that is assets is equal to liabilities plus owner's equity. These three things are the components of what a balance sheet is. In fact, the balance sheet is called the balance sheet because it literally is something that has to keep balanced. On one end, you have the assets, and your assets have to be exactly equal to your liabilities and equity. And if they aren't, something has gone terribly wrong. Now that you have a bit of some conceptual understanding with regards to what a balance sheet is, I'm going to now illustrate exactly what it looks like. Let me show you. Here's a reminder of the equation that we just spoke about. Your assets are equal to your liabilities plus owner's equity. This equation is to never be forgotten in accounting. Why? Because these are the three components of a balance sheet. As I mentioned, a balance sheet must always be balanced, and a balance sheet is always demonstrating the financials as of the end of a specific period. Your assets are on the left side, and on the right side are your liabilities and owner's equity. Now that you can visualize what a balance sheet would look like, I will now go into the details with regards to what are assets, what liabilities are, what owner's equity is, and what necessarily entails these things. So the components of the balance sheet are the assets, the liabilities, and owner's equity. But what are assets? Assets are anything that the company owns that holds a future value. Anything that tomorrow will have value. It can be cash, it can be an account receivable, which we will go into, supplies, or anything else. Property, plant, equipment. Liabilities are something that the company owes. Anything like debt, for example. And equity are things that help finance the company, like common stock. Let's start with assets. First, usually on a balance sheet, we start with the most liquid form of assets, which is cash and cash equivalents, such as money orders, checks, etc. Then we go into accounts receivable, abbreviated here by AR. Next, we have things such as supplies and other things, and usually property, plant, and equipment, abbreviated by PP and E. Next, we can go into liabilities and forms and types of liabilities. As I mentioned before, liabilities are types of debt like accounts payable, abbreviated by AP, or notes payable, abbreviated by NP. And then owner's equity, which includes things such as common stock, which is abbreviated by CS, and retained earnings, abbreviated by RE. Every single day, a corporation goes through a number of transactions. Now what I want to do is illustrate how a transaction affects the balance sheet, and we will use something called journal entries to give you more exposures as to when to debit or when to credit. The introduction of financial reporting can be dated back to the 1400s with Luca Pacioli, who introduced the idea of having debits and having credits to go about introducing the fluctuations of assets, liabilities, and equity on a balance sheet. Debits are usually on the left side, credits are on the right side. Now, the question that arises is when necessarily do you debit a specific account on the balance sheet and when do you credit one? Well, here's a very easy way to learn. Always debit when one of your assets, which is on the left side of the balance sheet, is increasing, meaning you, as a corporation, are receiving cash, for example. On the opposite end, you always credit an asset when the asset is going down. So, for example, a payment of anything. Now, because liabilities and owner's equity are on the opposite side of the balance sheet as assets, it has a different effect. When liabilities go down, you debit the liability. When liabilities go up, you credit. Similarly, because liabilities and owner's equity are on the same side, they have the same effect. Let's use Apple to illustrate an example of how a company purchases something and notes it and how that affects their balance sheet. Let's say Apple goes to Staples and purchases $500 of office supplies. What is given and what is taken away? Well, let's assume Apple decides to make this purchase on credit, which means they will not necessarily be paying in cash. What happens then? Let us illustrate. On September 30th, 2012, Apple Corporation decided to purchase $500 worth of office supplies. Now, office supplies is an asset. And so because they are receiving this asset is going up. When we perform a journal entry, we are debiting our asset, which means we will debit office supplies for $500. And as I mentioned, always debits are on the left, and so $500. Now, what do we credit? Well, as I mentioned earlier, they did not purchase the office supplies in cash. They were purchased on credit. Because of that, Apple has a liability. They owe money. They have an accounts payable, denoted by AP, of $500 because Apple is now liable to pay Staples $500. And this is precisely what a journal entry looks like. Now, using this example of Apple buying office supplies, we're also going to use T accounts to illustrate how this transaction essentially affects the balance sheet. A T account, in essence, is a specific T-shaped account with the account name. So let's use office supplies, which is one of the accounts, and then the other one, accounts payable. These are the two accounts that are being affected with this specific transaction. Because we are debiting office supplies, because we, Apple Corporation, are receiving an asset. For this reason, $500 would appear on the debit side of the T account. Similarly, because we credited accounts payable, because now we have a liability. For this reason, $500 would appear on the credit side of the accounts payable T account. And so T accounts and journal entries are used to illustrate transactions on a balance sheet. Thank you for watching my video. I hope that it has served as comprehension in terms of the fundamentals of financial accounting. Hopefully you've learned a bit about a balance sheet, what it is, the components of a balance sheet, such as the assets, the liabilities, owner's equity, and how a transaction can fluctuate the items on a balance sheet, which can be demonstrated by journal entries and T accounts using debits and credits. I hope that you've enjoyed the video, and if you've enjoyed my method of teaching, I highly encourage you to follow me and add me to your playlist. Thank you for watching.